Bull bars and bear bars. Let's talk about that real quick. And we'll kind of go over some more things in here. We'll kind of go over a quick overview of bar theory, and we'll talk about a little bit of everything when it comes to the actual basics here. So first off, the bars, we have an open, we have a close, and we have a tail or a wick. How do we tell the difference? Well, we take this bar right here and we say that, okay, the beginning of the colored area, the green area right here, this right here is the open. From the open, it had a slight push down that created the tail, and then it continued up, and it closed at its high point. The next bull bar in here opened, had a push down, created a tail, had a push back up, and a small retracement, creating a wick at the top, the bottom, and this right here is the end of the body. This is very important. If we're looking at a bar and we want to be able to tell the areas of strength, we look at the body. How big is the body? Does it close at its high? Does it close at its high here? No, because we have a wick. It closes at its high here. It almost closes at its high here. Now when we're talking about bars, we have different kinds of bars, and different kinds of bars have different meanings. I kind of briefly went over the open and the close and the wicks of the bars, but I'm mostly just briefly going over this for the sake of completion, because I'm assuming that you probably know at least most of that by now. Now we have other kinds of bars. We have lots of different names that we can put to them, but we're primarily looking at trend bars and doji bars. If we had to split them up into just two simple sections, it's pretty much how we would do it, trend bars and doji bars. What's the difference? Well, a doji bar is a trading range. They happen at different types of different times of the day. They can be different sizes, but a unique characteristic that all of them have is they all have wicks at the top and the bottom. Top and bottom. Top and bottom. Top and bottom. Top and bottom. What they don't have is wicks only at the top. This bull bar here, zoom in a little bit. This bull bar right here, this is not a doji. Let's see if we can find another. This is not a doji. This is not a doji. This is not a doji. This is a doji bar. What is a doji bar? Well, ultimately it's really just a trading range on a small time frame, and this is the 5 minute, so you would have to get extremely small to really see this range. But on a small time frame, this right here is a range. Range, 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 break of the range, tempt up, push lower. These are all microscopic ranges. It's also a point of agreement, or it can be a point of hesitation. If we start to get too high and we're at a point of resistance, we might find more doji bars. If we start to get too low and we're at a point of support, we might find more doji bars. The other kind of bars we have are trend bars. Now, these bars have several different looks to them. They can be like this, and they can close at their high. They can be like this, and they can close near their high, near their high, near their high. If they have long tails like this can often mean that price is pushed down to an area and was rejected from it. And in this case, we had a fairly good finish. We can go on like this forever and ever and ever. Notice how many doji bars are in this channel right here. Not many. This doji bar has a tail at its high and its low. This also has a tail at its high and low tail. Most of these bars are trend bars closing near its low. Tiny tail up top. Not much of a doji here. Good finish here, here, here. Now, a good question is, how exactly do we define a doji bar? Because just saying that a wick at the top and the bottom is a relatively loose definition, and sometimes you'll see me give rather loose definitions, and that's because the market is a loose place. It's very subjective. What you see here in front of you is not necessarily what someone else will see. Even traders who trade with the same strategy and the same rules will often take trades against each other, simply because they see two different things. It's not necessarily uncommon. Granted, you could say that if that were to happen, then those traders would probably also likely be taking a lot of the same trades as well. It doesn't mean that the market is any less of a subjective place. So when we look at these doji bars, you see a tail up top and a tail down low. Is this a doji? Probably not. Is this a doji? Probably not. Is this a doji? Probably not. And how can we tell that? Well, it depends on really what the market makers think it is. However, we can get pretty close to what they think it is if we simply just find the open being here. We find the high point being here. And we find the close of the bar being about here. And we say to ourselves, how did it close? If this was the open and this was the close, this middle section here, where, if this was the open and this was the high and this was the close, how did it close? Well, if it closes 2/3 the height of the bar or greater, it's generally safe to assume that it is a trend bar, or at least a bar with some sort of power to it, some sort of momentum. It may go on for several more bars, or it may go on for only one or two. If we look at this here, it's a gray bar, tail on both ends. They're both long. It was obviously a weak close. It's fairly safe to assume that this is a doji bar. Now, sometimes we see what we look like are trend bars, but are actually kind of tricky. I have a few examples here. First one is going to be this big bear bar. We have a large bear bar, and it closed at its low. Not much room here. Basically closed at its very low, about a tick of difference. And what happened? Well, the market continued to range for several more bars. Here, we have a bear bar closed at its low. Was there much follow through to it? No, not really. It came up, at least for a little bit longer. We see this a lot in trading. These right here are climactic. And if there's no follow through to them, then you have to think to yourself that, well, maybe these aren't quite as strong as I thought they were. You can ask yourself, who's on the other side of your trade? Here's another example. Bull bar closing at its high. What happened next? Not much follow through. Push down below, and another push up. Bull bar closing at its high, weak follow through. Good bull bar closing at its high, and we have some follow through. We have two bull bars that pushed up a little bit higher. Now I want to make clear that these examples that I'm giving here are small bits of information that the market gives you, but none of these confirm or deny a trade. It's simply a tidbit of information. Now it's your job to go and to gather more information and to determine for yourself if the probabilities of making a winning trade line up or not. This is simply just step one of finding that information. Now we also have bars with gaps. And a lot of people like to say that the gap always gets filled. However, I think that using the word always when it comes to the stock market or the futures market can be very dangerous. The gap sometimes gets filled. Will the gap get filled? I don't know. And frankly, there's no way to know except to read the price action that's currently in front of you and determine the probabilities of reaching that gap. Then when you get to the gap, you have to ask yourself, are we going to the middle of the gap? Are we filling the gap? Or are we going to be rejected from the gap? However, there's other ways that we can use gaps in trading. This happens primarily on the 5-minute chart. So if you're looking at a trade, if you're looking to go here as an example, and you're looking at this on the 2000 tick chart, and you see that you think that you have a good setup, and then you take a look at the 5-minute chart and you see that we have a gap opening. A gap opening is simply an opening between the close here and the open of the next bar here. And you say, well, it's a gap opening, and I think that we have some momentum on the 5-minute chart, and maybe this will validate my trade on the 2000 tick or whatever time frame you choose to trade on. We have them all over the place. We even have one here that I don't have marked. We have one here. We have one here. These are all very key areas, and notice how when the price is dropping, we continue to get gaps in the price. This shows that sellers are not only just selling into the close of the bar, but they're aggressively selling at the end of every bar, which makes it a very effective stock market order market. Let's talk for a second about signal bars and why they're important. If we're going to take a trade, and let's say that we want to take a second entry, first entry long, second entry long. If you're confused about why these are first and second entries long, then I will explain in a different video. It's not really something for a video like this. I want to stay focused on the bars themselves. But if I were to take this trade, and let's just say that I was going to enter on a stop market order at one tick above the height of the previous bar, and my stop loss would be one tick underneath the previous low here. If I'm entering this trade, I have to have a signal bar, meaning that when this large bull bar fills my order, I'm using the previous bar as a signal bar. Now a signal bar, you can have a good signal bar, you can have a bad one, or you can have an okay one. I would say that this is a relatively okay signal bar. What are some aspects of a signal bar that we're looking for? Well, we want something with a tail. We want something that shows that price has gone down, in this case, has been rejected from a level, and appears to be rising. So we want to find evidence of that. The next thing we're looking for is either a weak bear close if we're going long, or any sign of bulls buying in this area. So what would probably make this signal bar better is if it was bullish by at least 2 or 3 ticks. Here's an example of a signal bar that maybe isn't the best, although in this context, to me, it was a halfway decent signal. A little bit difficult to see because it's a picture. However, we have a push down outside the range. This bull bar here is our first attempt up. this bear bar, if we look at this bear bar, it has a pretty strong close, certainly closes in that 2/3 area, which means that the bar has strength. However, despite that strength, there was no follow through. For me, this is why this is a good trade. However, especially when you're first starting out and you see a large bear bar and you're looking to go long, this is generally something that you want to avoid. Just because something looks, or just because something happens being a second entry, doesn't mean that you have to take it. If we look back at our signal bar, we can find evidence if the bulls are in the market buying or not. Let's look at this trade here. Not necessarily the best signal bar. It does have a long wick here, and it is at a key entry area. The bear bar, the body finished about 50% of its height, which means that it's not especially strong, but it's still there. This could have potentially converted into a small range. It just didn't. Let's look at here. We have our first push down. We have a push up. If we're looking to go short here, what kind of a signal bar do we have? Well, our entry does not trigger into this bear bar. This previous bar is an inside bar, which does indicate that there may be some sort of a small range coming. However, it closes near its low. And this right here does signal that there are at least some bears in the market trying to sell. Previous bull bar that closed at its high didn't go very far. Bear bar pushed down and retraced. We have another where we have a good close on the next bar. This right here becomes a signal bar. This right here becomes the entry bar. A signal bar is only a signal bar if you choose to take a trade off of it. If you don't choose to take a trade, then signal bars do not exist. They cannot exist because you're not using them as signals, because you're not actually taking a trade from it. What does the perfect signal bar look like? Well, I'll show you a pretty good one. Although, if I'm being completely honest, most of the time, it's pretty difficult to find the perfect signal bar in the market. With that being said though, if you ever feel like the possibilities are 50-50 if a trade is going to win or not, and you get a bad signal bar, your probabilities are immediately lowered. And if you're already not sure about something and you can't find confirmation of the market at least beginning to go your way, then maybe we should reconsider the trade itself. Here we have a second entry short as well as a second entry long trap. First entry short, here this tail, push up above, came back below. Now we're going to look up here, push up, and then a push down. If we enter here, one tick below the previous bar, then this right here, the previous bar, is our signal bar. This is a very nice bar. Why? There was a push up, we have a long wick, and there was a push down, and the bar ended with a bear body. It ended with a bear body, so that tells me that the bears are in the market and they're beginning to sell. The only question now is, will they continue to sell? And in this case, they did. Switching over to the 2000 tick now, let's talk about inside bars and outside bars. This is also very important. You have to know the difference. If you start to see a lot of inside bars, you have to wonder if a range is beginning to happen. If a range is going to be happening, you have to be extremely aware of where you take a position at, where your stop loss at. If you're not careful, a lot of times the volatility of a range will take you out before meeting your target. So let's talk about inside bars and outside bars. Let's talk about inside bars first. What is an inside bar? Simply put, an inside bar is any bar that did not break the previous bar's high or low. In this example here, if we take the high of the spare bar and if we take the low of the spare bar, straighten up the lines a little bit, we can see that this bull bar right next to it did not break the high or the low of the previous bar. This is an inside bar. Now let's look at the very next bar. Let's take this bull bar's high and the bull bar's low, and let's ask ourselves, did this bear bar break the previous bar's high or low? No, it did not. It's an inside bar. We can do this one more time. We can take this bar's high and this bar's low, and we can say, well, did this gray doji here, did it break the previous bar's high or low? No, it did not. It is therefore an inside bar. And in this specific case, it's kind of unique because we have an inside, inside, inside pattern. It's not too uncommon to get one inside bar. It's not even too awfully uncommon to get an inside, inside bar, but 3 in a row is certainly really interesting. Now, let's talk about outside bars. What is an outside bar? Simply put, an outside bar is any bar that broke the previous bar's high or low. So in this example, if we mark the high of the spare bar and we mark the low of the spare bar, and we ask ourselves, did this bear bar break the previous high or the low of the previous bar? And of course the answer is yes. Now that the answer is yes, we know that this is an outside bar. Now, did the next bar over, did it break the previous bar's high or low? No, it did not. It is an inside bar. One more time. Did this bull bar break the previous bar's high or low? Yes, it did. Even though it broke it and came back into the area of the bar, it's still an outside bar. Now this next one should be easy. Is this an outside bar? Yes, because we went above the high of the previous bar. We can continue to do this for our bars over and over and over again. And they show signs of strength. Outside bars is a sign of strength. It's a small piece of information that you need. So we say that this is an outside bar. Did it close at 2/3 its height or higher? Yes. Does it have follow through? Yes. Well, then we can go back and we can say that this bar has strength. There is some strength in this area. How strong is it? Well, that is the question, and each answer is going to depend. However, we do have evidence of strength here. There's bulls buying. Now let's talk real quick about how we can tell strength in bars. Lots of different ways here. Lots of different questions we can ask ourselves to determine the strength in the bars. First question, did the bar close at or near its high? In this case, yes. Now, if we want to determine the strength of the bars in a trend, we can go to the next bar and we can ask ourselves, did this bar have a higher low? Yes, it did. Did the next bar have a higher low? Yes, it did. Do both of them have higher highs? Yes, they do. We have a small pullback. Did this bar have a higher low? No, it did not. this bear bar does not have a higher low. If it did, then we wouldn't be breaking the previous bar's low. Did this bar have a higher low? No, it did not. Did it close above the range at or near its high? Yes, it did. Did the next bar have a higher low? Yes, it did. These are all indications that the trend is still strong. Bars closing at or near their highs, small amounts of bear bars in the channel itself. If we go through and we count the bear bars, we can count 1, 2, 3, 4, 5 bear bars. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 bull bars. It's a big difference. So who do we think has control over this? Obviously the bulls. Now, if we look at this and we look at this section here, we see the exact opposite. We see mostly bear bars. Now obviously the bears have control here. We want to see lower highs, which we do. We want to see bear bars closing at or near their lows, which we see here. Now let's ask ourselves, when we do see bull bars, what happens to them? Well, let's go back and use context to find out. In this area, there were 2 bull bars. One of these bull bars closed at or near its high, and it had no follow-through. It was climactic. Good bear bar here with a little bit of follow-through. Here's another bull bar. Not a bad close. Is this a reason to buy? Absolutely not. There's no follow-through. 2 more bull bars. 1 bull bar, 2 bull bars. Now we get to kind of an interesting area where we've gotten so low now that we have a bull bar, we have some dojis, and then 2 more bull bars. Small range with some bull bars that don't go anywhere. Probably bulls starting to buy just a little bit in this area. And this is where bears began to take profits and the bulls began to buy. Whenever we have these trends like this, don't be afraid to go back at it and ask yourself, how many bull bars, how big of a pullback do we have before we need to look to go short again? Well, in this case, we can see that the market generally is only giving you 1 to 2 bars of a pullback before you need to look to be short again in the market. In this case, it's even less. There's only about 1 bear bar each time. So if we see 1 bear bar or 2 bear bars and they're at a good entry point, we can assume that it would likely be a safe place to enter long. Things to look for: lower highs in a bear, higher lows in a bull, bars closing at or near their highs or lows with follow through, pullbacks that don't go anywhere, and good strong trend bars.